Have you ever wondered if there's a way to participate in the stock market with potentially higher returns, or even protect your existing investments without buying or selling shares outright? What if I told you there's a powerful financial instrument that allows you to do just that, offering flexibility and leverage that traditional stock trading often lacks? We're talking about options trading, and specifically, how you can navigate this exciting world right within your Ally Invest account. Now, before your eyes glaze over or you click away thinking this is too complex, hear me out. Options, while initially seeming intimidating, are simply contracts that give you the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. Think of it like this: you're essentially buying a reservation for a future transaction. This tutorial is designed to demystify options trading on Ally Invest, breaking down the concepts, showing you the platform, and walking you through the steps to get started responsibly. My goal isn't to turn you into a day trading guru overnight, but rather to equip you with the foundational knowledge to understand what options are, how they work on Ally Invest, and how you can potentially integrate them into your investing strategy. We'll cover everything from the absolute basics like calls and puts, to understanding strike prices, expiration dates, and premiums. We'll explore why investors use options, whether for speculation, income generation, or hedging, and crucially, we'll discuss the inherent risks involved. Because, let's be clear, options trading carries significant risks, and it's not for everyone. But for those who understand and manage those risks, it can be a valuable tool in their financial arsenal. So, if you're ready to unlock a new dimension of investing and see how Ally Invest makes it accessible, stick around. Let's dive in. Understanding the core, calls and puts. At the heart of options trading are two fundamental types of contracts, calls and puts. Think of them as two sides of the same coin, each representing a different expectation about the underlying asset's future price movement. Call options. A call option gives the holder the right to buy an underlying asset, like a stock, at a predetermined price, known as the strike price, on or before a specific date, the expiration date. You buy a call option when you believe the price of the underlying asset will increase significantly above the strike price before the expiration date. Let's illustrate with an example. Imagine XYZ stock is trading at $50 per share. You believe XYZ is undervalued and will jump to $60 in the next couple of months. Instead of buying 100 shares for $5,000, you could buy one call option contract, which typically represents 100 shares, with a strike price of $55 and an expiration date 2 months out. Let's say this contract costs you $2 per share, or $200 total, 100 shares x $2 premium. If XYZ indeed rises to $65 before expiration, your call option becomes highly valuable. You can exercise your right to buy 100 shares at $55 each and immediately sell them in the open market at $65, pocketing a $10 profit per share, or $1,000 total, minus your initial $200 premium. That's an $800 profit from an initial $200 investment, a significant return compared to buying the shares outright. However, if XYZ's price stays below $55, or even drops, your call option would expire worthless, and you would lose your entire $200 premium. This highlights the leverage and the risk. Put options. Conversely, a put option gives the holder the right to sell an underlying asset at a predetermined strike price on or before a specific expiration date. You buy a put option when you believe the price of the underlying asset will decrease significantly below the strike price before the expiration date. Think of it as insurance for your stocks, or a way to profit from a falling market. Suppose you own 100 shares of ABC stock currently trading at $100 per share, but you're worried about an upcoming earnings report potentially sending the stock down. To protect your investment, you could buy a put option with a strike price of $95 and an expiration date next month. Let's say this costs you $3 per share, or $300 total. If ABC stock tanks to $85 after the earnings report, your put option allows you to sell your 100 shares at $95, even though the market price is $85. This limits your loss on your ABC shares. You'd still be down $5 per share from the strike price, plus the $3 per share premium, but it's much better than being down $15 per share if you didn't have the put. Alternatively, if you don't own the stock but believe it's going to fall, you can buy puts speculatively. If ABC drops to $85, you can buy 100 shares at $85 in the open market and then immediately exercise your put option to sell them at $95, making a profit of $10 per share, less the premium. Key terminology and concepts. Now that we have the basics of calls and puts, let's unpack some crucial terms you'll encounter in options trading. Underlying asset. This is the security, most commonly a stock, but can also be an ETF, index, or even a commodity that the option contract is based on. The option's value is derived from the price movement of this underlying asset. Strike price, also known as the exercise price. This is the fixed price at which the underlying asset can be bought for a call or sold for a put if the option is exercised. Expiration date. This is the final date on which the option contract is valid. After this date, the option expires worthless if not exercised or closed. Options typically expire on the third Friday of the month. Premium. This is the price you pay to buy an options contract. It's the cost of the right to buy or sell. The premium is influenced by several factors, including the underlying asset's price, the strike price, the time until expiration, volatility, and interest rates. With that said, thanks for watching and until next time.